Welcome back. Today we're conducting a 10-minute deep dive into Target's latest earnings report. We'll analyze 12 key charts covering top-line growth to analyst projections. Before we start, please like and subscribe for more research. Let's look at the numbers. Starting with revenue, Target continues to demonstrate its position as a retail powerhouse. The chart shows a strong upward trajectory over the long term. In the latest quarter, revenue grew by 3.2% year over year. This reflects steady performance despite a highly competitive macroeconomic landscape. Looking back at the last decade, we see how Target has successfully scaled its operations, driven by a powerful mix of in-store and digital sales. The 5-year and 10-year compounded annual growth rates highlight the company's long-term consistency and its ability to maintain a strong market share. This resilience is a key factor for investors. As the Target model proves, it can adapt to shifting consumer behaviors and economic cycles. Overall, the revenue data paints a picture of a healthy business that continues to expand its reach, providing a solid foundation for future growth. Looking at profitability, EBITDA trends reveal strong operational efficiency. The company grew its EBITDA by 16.2% in the latest quarter. This indicates that Target is successfully managing operating costs and optimizing its inventory levels in a notoriously tight margin retail environment. Profitability is highly supported by Target's digital fulfillment strategy, leveraging its physical stores to significantly reduce costly last-mile delivery expenses. The 5-year CAGR for EBITDA reflects the steady optimization efforts undertaken by management, showcasing their ability to preserve margins during supply chain stress. This level of performance suggests that the company is effectively utilizing its massive asset base to generate healthy returns for its shareholders. In summary, the EBITDA chart highlights a disciplined approach to operations, prioritizing sustainable profit generation alongside its continuous top-line expansion. Net income corroborates the resilience of the business model over decades of operation. In the most recent quarter, net income saw a significant 25.3% jump. This reflects strong bottom-line performance driven by effective cost control measures and a strategic focus on high-margin owned brands. Such profitability is supported by Target's ability to drive efficiency across its supply chain and optimize its diverse store-based fulfillment model. Even during periods of global economic uncertainty, Target's net income remains resilient, thanks to steady consumer demand for essential goods. These robust earnings provide the necessary funds for Target's generous dividend policy and its ongoing capital return program for long-term shareholders. Overall, the net income data reinforces Target's status as a top-tier retail asset with a clear path towards sustained future profitability. Earnings per share data provides a clear picture of value creation for Target's long-term shareholders. In the latest quarter, EPS grew by a healthy 23.7%. This demonstrates the underlying strength of each share in the public equity market, particularly impressive given the competitive nature of modern retail. The consistent trend in EPS also reflects Target's disciplined approach to share repurchases, which helps to increase the value of remaining shares. With a 10-year CAGR of 2.5%, Target has delivered reliable and steady earnings growth, making it a staple in institutional portfolios. The historical upward march of EPS provides a solid foundation for future valuation models and long-term earnings projections used by Wall Street firms. In summary, the EPS chart visualizes a multi-decade story of compounding value and financial resilience for Target's dedicated shareholder community. Target's balance sheet remains a key area of focus, showing strategic management of debt and liquidity to fuel ongoing operations and growth. Looking at the chart, green bars represent cash reserves, while the red bars show total debt, illustrating the company's long-term leverage profile. While total debt has increased to support large-scale investments, it remains highly manageable given the company's massive annual EBITDA generation. The historical trend shows that Target has consistently maintained enough liquidity to navigate seasonal fluctuations and various economic retail cycles. A significant portion of the reported debt includes long-term lease obligations for its massive network of stores across the United States. Overall, the cash and debt position reflects a stable and mature organization that is well-positioned to fund its strategic objectives for years. A pillar of the Target investment thesis is its storied history of growing dividend payments, a tradition that spans several decades. The steady upward march of the blue bars represents Target's status as a Dividend King, having increased its payout for over 50 consecutive years. In the latest quarter, the dividend grew by 1.8%, and the 5-year CAGR of 10.9% highlights a significant acceleration. This consistent dividend growth is a clear signal of management's commitment to returning a substantial portion of profits directly to its investors. Despite the rising payout, Target maintains a healthy payout ratio, ensuring that the dividend is well covered by its recurring net income. In summary, the dividends chart is a visualization of Target's enduring financial health and its shareholder-first approach to long-term capital allocation. The return of capital chart visualizes Target's long-term commitment to returning value to its shareholders through multiple diverse channels over the decades. While dividends represent a steady return, share repurchases provide management with a tool to opportunistically reward investors when the stock is undervalued. The chart shows a consistent history of returning capital with dramatic spikes in activity in the 2021 and 2022 fiscal periods. Management carefully balances these capital returns with the internal funding requirements for store remodels and major technological supply chain upgrades. By reducing the total share count over time, Target increases the ownership stake and future earnings power for each remaining share held. In summary, the return of capital strategy is a cornerstone of Target's attractive profile, offering a potent mix of yield and per-share growth. Analyzing the core financial ratios gives us deeper insight into the operational health and margin stability of Target Corporation across different market cycles. The ratios chart shows remarkably stable performance metrics over the last several decades, illustrating a disciplined approach to pricing and inventory management. Compared to its peers, Target consistently maintains superior operational ratios, justifying its premium valuation and inclusion in many professional investment portfolios. The resilience of these ratios during the recent inflationary period demonstrates management's success in mitigating rising input costs and supply chain headwinds. The steady return on invested capital highlights Target's ability to generate attractive yields on the billions of dollars it reinvests back into stores. Overall, the financial ratios chart confirms a well-run organization that continues to optimize its performance for the benefit of all its long-term stakeholders. Capital expenditures reflect Target's ongoing and aggressive investment in store remodeling, digital fulfillment, and the future of the modern shopping experience. A large portion of the blue bars represents the massive annual spend dedicated to refreshing the existing store fleet, keeping the brand modern. Significant funds are also allocated towards supply chain automation and digital fulfillment technology, critical for competing in the omni-channel retail landscape. The chart shows a notable increase in CAPEX over the last few years, reflecting a strategic decision to double down on Target stores. The 10-year CAGR of 9.8% in capital spending proves that Target is not stagnant, but constantly evolving its physical assets. In summary, the capital expenditures chart visualizes Target's proactive approach to future-proofing its business through disciplined and strategic financial investment. Looking forward, Wall Street analysts maintain a closely watched outlook for the remainder of fiscal 2026, as evidenced by the clustering of estimates. For the current quarter, the consensus average EPS estimate among 19 analysts is $1.35, representing continued strong performance. The expectations range from a low of $1.26 to a high of $1.49, suggesting a fair degree of certainty. Moving to the full current year, 26 analysts have provided a consensus estimate of $8.71 for the company. The average estimate for next year sits slightly lower at $7.97, reflecting analyst caution on consumer spending. In summary, the analyst estimates provide a cautious but stable outlook for Target's long-term equity positioning within the broader retail sector. The valuation summary provides a comprehensive look at how the public markets are pricing Target Corporation today across several key financial metrics. With a market cap of $54 billion, Target's trailing price-to-earnings ratio is 13.61, representing a very reasonable valuation. The enterprise value to EBITDA ratio of 6.25 further highlights the company's strong operational efficiency relative to its market value. Investors are also focused on the free cash flow yield of 5.36%, which supports the company's healthy dividend distribution. Margins remain tight but healthy, with a 3.80% profit margin and a 5.28% operating margin profile. In conclusion, these metrics describe a company with strong fundamentals, low debt, and an attractive value proposition for long-term retail holders. Finally, let's examine the real-time market activity for Target Corporation stock, traded under the ticker TGT on the New York Stock Exchange. The stock recently closed at a price of $120.34, marking a modest daily gain of 0.22%. This positive price action reflects steady investor confidence following the latest earnings release and the subsequent management commentary. For many investors, Target represents a core retail holding that offers a balance of defensive stability and steady income through market cycles. As the fiscal year progresses, the stock's performance will remain closely tied to these fundamental data points and broader consumer sentiment trends. The resilience of the stock price confirms that the market views Target as a durable player in the increasingly competitive retail landscape. In summary, Target's Q1 2026 results reinforce its long-term dominance. Thank you for joining this analysis. Like, subscribe, and we'll see you in the next one.